Hello, good evening, good students. Today is a good day for us because we want to learn about financial modeling as usual. I know sometimes it might be difficult to record the classes, but the one we record, the better. So, from our last classes, we were talking about some of the financial modeling, financial statement analysis tools that are mostly used or commonly used in finance. So last time, if I'm not wrong, we left at the point where we were supposed to be looking some of the analysis tools, and we agreed very well there are very many tools in finance as it is concerned. Some of the tools that we looked at for preview purpose, we looked at financial statement of cash flows, balance sheet, assets. Then we look something to do with statement of changes in ownership. Then the interrelationship of the four financial statement, where the first financial statements are just income statement, statement of financial position, we have cash flow, then we have financial tool as ownership is concerned. Then these are the financial statements. So we look at the statement of cash flows, and we learned that this mostly involve on changes over the entire year. Then balance sheet, just a snapshot of just 1 year or 1 day or any other day. But as an account is concerned, you know that asset is equal to liabilities plus capitals, and by now everyone should have known that. Then in statement of cash flows, you will find that there is net cash flows, where we have operating cash flows, we have investing cash flows, then we have financing cash flow. All that sum up to a total cash flow at the end of the year, or net income. If you have your operating cash flow, investing, then financial cash flow, you will come up to your net income. And that is why you can see there is an arrow here. At the end of your cash flows, we have cash. Then from that, asset is equal to liability plus capital. Then all this applies as we talked about them last time. In income statement, which is here, you have revenues, then you have cost of goods sold, then gross profit. Gross profit is always related with gross profit margin. Then we have spending or expenditures, which can lead us to operating income. And if that is not enough, if you less other expenses or non-operating, you are going to have your net income, resulting to earning per share. So today we are supposed to look at these analysis tools, where we are supposed to be looking horizontal stroke trend analysis. Then we were supposed to be looking at vertical analysis. So we have very many tools in finance. So we have horizontal, vertical, ratios analysis. And to begin with the first one, which is horizontal analysis, you find that in horizontal analysis as a tool of financial statement analysis, you will find that it always concerned with changes that are always measured against a base year with the following formula. So you relate all your financial flow with a base year. So you will find that the current asset year amount minus a base year amount all over period base year amount, you're supposed to get your horizontal analysis. What is this base year? Base year is just like the year you are doing your financial planning or your financial reporting. So For horizontal analysis, you will find that the base year, you deduct it from your current year, then all over the base year, you are supposed to get your horizontal analysis. So for this information, we have 2013, 2003, and 2002. For this case, as a good student, this is statement of balance sheet, or a balance sheet in simple term. And you can see we have asset, liability, stock holders, equity, where in asset we have current asset, plants asset, intangible asset, which result to a total asset of 1.835 million. Then liability, we have current liability, long-term liability, total liability summing up to 832,000. Then stockholders equity. So under that, stockholders equity, which has common stock, we have which is $1 per. Then retained earning, which is 727. Then we have total stockholders equity 1 million. Then you have total equity plus total stakeholder equity. So how do we, or at what stage do we call this one an horizontal analysis? From the word horizontal, horizontal is always a flat, vertical is always from up to down. So that is a simple way of differentiating between horizontal analysis and vertical analysis. So the base year is the previous year, and the current year is the year after the previous year. I'm repeating, the base year is the year which is the previous year. Then the current year is the year after the previous year. So under this scenario, 2002 is the previous year, and it is always the base year because it is before 2003. Then 2003 is the current year after the base year, which is 2002. So for that case, in horizontal analysis, you take the current year from the formula above. You take the current year amount minus base year amount all over, or everything over period base year amount. That is horizontal analysis. And if you can see, if you just take 1,020,000, you subtract 945,000, you are supposed to get a difference of 75,000, and that one should be the different. You are supposed to get that 0, 20 minus, you're supposed to get 75,000, and everyone can confirm if this calculation here, you take 945 subtract from 1020, you're supposed to be getting your answer correctly. Then another good example how you get an horizontal analysis, you're supposed to be taking, let's look at the total assets. Total asset here is 1,835,000. That is in 2003, which is the current year. Then in 2002, which is the base year, is 1,595,000. So you are supposed to take this figure, you subtract it from this, and it's supposed to give you a result of 240,000. You are supposed to be getting 240,000. And if that is not enough for current liability, how to get an increase or a decrease for let's say a good example of 2003, 2002. So this is the current year, this is the base year. If you take this, you subtract from this, or if you take this, subtract from this, you're supposed to get negative 2,500. That is what you're supposed to be getting. So for that case, horizontal analysis apply. You take the current year minus this year. How do we get now the percentages or the horizontal analysis now by itself using percentages? As this formula is concerned, after getting the increase, and that is what we have been doing, just taking the current year amount minus base year amount, then you're supposed to be getting a decrease or increase in the horizontal analysis, which is here. For you to get the percentage, you take current year's amount minus base year's amount, everything all over base year's amount. And if you, the different here is 75,000. This 75,000 is supposed to be divided by the base year's amount. So you take 75,000, all these figures, which is an increase or decrease during 2 or 3, you're supposed to divide them with the base year's amount. A good example, if you take 240,000, which is the total liabilities and stockholders equity, you're supposed to be getting 200, you take 240,000, take 240,000, divide by the base year is 202, which is 1,595,000. Then after you getting that, because it is in percentage and percentage is always over 100, you multiply by 100. You are going to get 15.0470219436%. So for this case, you just round your figure into one decimal place. Since 15.047021 is more, you just put it at 15.04 or 15.0. That one is the right answer. Another sample, how to get an horizontal analysis, you can take a good example of our current liability, which is here. You take the total amount or the total increase or decrease in 2003, which is for current liability is 41,500. Then you divide it by this, which is 303,000. You're supposed to be getting 13. You are supposed to be getting 13.696396. But for this case, we just round up to one decimal place, like 13.6963 is rounded off as 13.7, and that is how we get horizontal analysis in financial statement analysis. That is all to do with financial statement analysis tool in horizontal analysis. You simply take current year minus base year divided by base year. And I have said base year is always the previous year. Current year is the year we are in. A good example, we are in 2022 and last year was 2021. So here, the previous year, which is 2021, is the base year, and 2022 is the current year. You simply take the figure for this year minus the figure for last year divided by the figure of last year. You get your percentage. And you know percentage is multiplied by 100. And you are done for horizontal analysis tool in financial statement analysis. The second, that is that one we were doing it in a balance sheet, but you can also do the same in income statement. For income statement, you apply the same. 202 is the base year, 2003 is the current year. Take the figure here in the current year minus the figure here in the base year. divide by the figure in the base year, then you multiply by 100. You are supposed to be getting all these percentages. That is the simplest way of getting your horizontal analysis tool in financial modeling, in financial statement analysis. Horizontal analysis of retained earnings statement. How does this apply for this company? The same procedure is used. You don't need to worry. Either increase or decrease. Like retained earning in January is $1, which is 525,000, and here is 376,500. You get the difference between the figure of retained earning here and the figure of retaining earning here. If you get the difference, you're supposed to be getting this. Then you divide by the current, the base here, which will give you 39.4%. And that is all to do with retaining. You can see, as simple as that. You just take 5, which is the current year, minus the base year, divided by the base year. You're supposed to get 39.4%. And that is all to do with financial statement analysis for horizontal analysis. Thank you guys. Let's meet next time as we enjoy our nice class. Thank you all. Be blessed abundantly.